Welcome back, Bruce. For the benefit of new viewers, can you give us an overview of your investing strategy?
Sure. At StoneCastle, we have really what we talk about as being a two-part process. So the first part of our process is our top-down process. So we talk about being on offense or defense, and we've got a number of different tools that we use to help us to guide whether or not our portfolios are that positioned that way. And then the second is our bottom-up process. So when we specifically look at our top-down process, we've seen some transition here this year. So we went into the year on defense, and then we've actually seen a transition probably around the March to April timeframe where we started to move our position back towards offense with our portfolios. And then just recently we've actually seen a fairly significant change with some of the underlying indicators that we look at, whereby we've now seen growth starting to outperform, and we talk about growth taking over control of the market from the TSX. So up until now, we've really seen value outperforming, and we feel that growth could start to outperform over the next few quarters.
The last time we spoke, you mentioned you like the healthcare space. Do you still see attractive investment opportunities there despite the fact that it's still pretty beaten up?
Yeah, certainly the sector hasn't performed very well over the last 12 months. And we're actually seeing, again, from some of our indicators, we're starting to see that perhaps there's going to be some more money and capital flow into that sector. From a valuation standpoint, we are seeing some fairly attractive values. Some of the companies that we've talked to you about in the past continue to look fairly attractive here. Our healthcare exposure is a lot lower than it's been in the past, but that being said, we've actually brought it up from where it was, say, 3 months ago.
Pardon the pun, but are you still high on the medical marijuana space in Canada?
Well, when we look at that space, that's one that we've talked about for probably a little over a year now. And how I would really see it is, we're seeing the end of Prohibition come, and we're experiencing it right in front of our eyes. And if you look at some of the medical marijuana companies of late, they've been really charging up the charts as far as their stock price goes, and that's really been a function of two different things: their earnings. So you're now starting to see some companies who are cash flow and EBITDA positive in the medical marijuana space. And then the second thing is that everyone is now starting to get prepared for the recreational market, which, depending on which analyst and which forecast you look at, could come as early as a year from now, but probably more realistically 18 to 24 months from now.
Which Canadian sectors do you think will outperform in 2016 and into 2017?
Yeah, so as far as sectors go, we're still very broadly diversified. So we own overweights right now in some of the industrial product areas. So some of the manufacturing, with the Canadian dollar being as low as it has been over the last year, we haven't seen the ramp up in production that we would have expected, but we're starting to see that now. So as an example, we own a company like Pacific Insight Electronics, which does contract manufacturing for a number of different car companies. They make some LED lighting systems and some wire harnessing and control modules. That's a company that's really benefited from the Canadian dollar, and you've seen their earnings really ramp up in the last, say, 12 months.
Do you typically prefer small cap stocks over larger companies?
What we're looking for is accelerated earnings growth, and so what we find is that really the small and mid cap area is the area that we can see that accelerated earnings growth. With a larger cap, macro big company, you don't tend to see the same amount of accelerated earnings growth. You might see a linear earnings growth, whereas if you step down into the sort of mid cap and small cap areas, that's really where you can see accelerated earnings for several quarters in a row.
What are some of the stocks that you like at this time, and why?
Well, Pacific Insight is one that that we find particularly attractive. Another would be a company called Terra Firma Capital, which is in the real estate lending business. Right now, they've had a little bit of news regarding one of their investments in Urban Corp, which has actually caused the stock price to drop down. It's actually trading below book value right now, and typically it trades at probably about 1.25 times book value, and it's trading at about 80% of book value right now. So just a bump from taking it from below book value to its normal range would be a fairly significant return on the stock price. As well, the company is growing substantially with some investments they've made in the U.S.
Thanks for stopping by today, Bruce.
It's been my pleasure. Thank you.